Hello everyone, welcome to the very first video on this channel. Before I begin, I need to introduce myself. I am JY and I'm currently a student, which means that I'm not qualified to teach you. But I release these videos in the hopes that this will help me in my revision and also help you with yours. The course we're taking right now is BAFB3013 Financial Management, and we're going to start with topic 1, which is cash flow estimation and risk analysis. In this topic, we'll be uncovering the profitability of investment projects, like should we invest in it or should we not? And how we do so is by calculating NPV. Let's begin. Here are 5 simple steps to calculate NPV, but before we even begin, we first have to identify what kind of investment is it. Is it a new project or is it a replacement project? If it is a new project, it is fairly straightforward, as we begin by calculating the amount of money we spend to acquire that project. This is money out. Next, we calculate the operating cash flows, which is money that comes in throughout the duration of that project. Next, we calculate the terminal value of the new asset, which is, let's say, the machine has a lifespan of 5 years. So at the end of that 5 years, when we dispose of it, how much proceeds do we make from it and how much tax do we pay or save from that disposal? So this is money that comes in at the end of its life. So from these 3 items over here, we calculate the net present value, which is essentially the present value of cash inflows minus the present value of cash outflows. And we accept it if it is a positive value. Positive value means that it's going to be profitable. Next, let's talk about replacement projects. It is slightly more complicated as it encompasses all 5 of these steps with extra caveats. With replacement projects, before you acquire the new one, you first have to sell the old one, and the amount of money you get from selling the old one is used to offset the price of a new one. This is pretty clear, I feel, but the difficult part comes in the operating cash flows, because it is not so simple anymore. When we prepare the operating cash flows for a replacement project, we have to constantly juxtapose the 2 different projects. Now, let's say if I were to continue using my old asset, the operating expense for it is 10,000 per month, okay? What if I buy the new one? The new one is gonna require additional cost. It's gonna cost 20,000 per month. So what amount do I put in my operating cash flows? It is the difference. The difference in the operating expense is what we take into account. So it is something that we have to constantly keep in mind when we prepare this. On the right side is my template for answer all questions pertaining to this topic. And on the left side, we have an illustration. Let's go through it together. You have been asked by the president of your company to evaluate the proposed acquisition of new equipment. Unless they further mention an old existing one, I'm going to assume that this is a new project. The equipment's basic price is 183,000, which we'll put here as the asset cost. And shipping cost will be 7,700. It will cost another 23,300 to modify it for special use by your firm, and additional 13,500 to install the equipment. So as you can see here, shipping cost, modification cost, installation of the equipment, all these 3 costs is part of other cost. Because if you buy the asset, but it doesn't get here, you can't use it, can you? Or what if they deliver it here to your factory, but they don't install it? You can't use it, you know? Therefore, all these other costs is actually part of our consideration. Okay, next. The equipment falls in the Makers 3-year class and it will be sold. Let's look into the Makers. Alright, here is the Makers. So under the Makers 3-year class, depreciation is 33% in the first year, 45% in the second year, 15% in the third year, and 7% in the fourth year. Let's go through this together. So depreciation for year 1, year 2, year 3, year 4 is the total cost that we calculate from over here, okay? The total cost times 33% times 45% times 15%, and finally 7%. So what is the yearly depreciation for this machinery? To be prudent, I suggest that you add this up at the end. Make sure it is 100% and it totals up to the total cost at the end. So after you've calculated the depreciation, just plug it in right here. 1, 2, 3, 4. Okay. Next up, let's go back to the question. The equipment, it will be sold after 3 years. So I now know that the terminal value of the new asset will happen at the end of year 3. So at the same time, the same thing goes for our cash flows. So we stop at year 3, okay? We don't calculate 4 and 5 anymore. And for N, we put 3. Yeah, when we discount the value eventually, we'll be looking at 3. Okay, back to the question. So after 3 years, okay, for 30,900, this is the disposal value at the end of, well, not at the end of the life cycle. When we sell it off, we will sell it for 30,900. We'll put it here, disposal value. The equipment is expected to generate revenue of 178,000 per year. Okay, we'll put it here. With annual operating costs, excluding depreciation, of 84,000. We'll put it here. Remember, expenses is a minus, okay? So we'll minus this out. The firm's tax rate is 28%, okay? So the 28% will be here. We'll use it to calculate the tax payable or savings eventually. And the same thing goes for over here, for the terminal value. Cost of capital is 10%. Okay, cost of capital. So we will use it for this PVIF thing. So this one. Alright, it looks like we have gone through the entire question. Now, I need to mention something. Over here it says cost of capital, right? Which I believe to be equivalent to WACC. When it comes to this topic, sometimes you will see other terms as well, such as required rate of return or discount rate. All of these are actually different things, but for the purpose of this topic, you can just think of them as the same, okay? All we want to know is, should I invest in this thing after accounting for the discount rate, the required rate that my firm requires me, or in the case of WACC, which is every year I have to pay 10% for my capital. So this new asset that I invest in better be worth more than that, okay? So yeah, let's go through the steps itself directly, okay? So let's take a look at step 2. We have the asset cost, the other cost, the total cost. Change in NOWC, it's not relevant, it's not in the question. It is a new asset, so there's no terminal value of old asset. So you can have your initial outlay here. Step number 3, you can calculate EBT from here. You can calculate the tax, earnings after tax. And if you take a look here, there's actually 2 depreciations over here. Now, why is this so? It is because in finance, we look at cash, okay? Money that actually comes in and out of our pockets. But in accounting, we like to put in a depreciation to reduce the tax, okay? And that's what is in this table, to reduce the tax. And then after we calculate the tax, we add it back in. So whatever you put here, up here, you just add it back in, okay? And from here, you can calculate the cash inflows, the PVIF, just get it from the TVM table, you times it, you get the discounted cash inflows, add it up together, and then you get discounted cash inflows. All right, next, step number 4. Total cost comes from here. Accumulated depreciation. Now, where do I get it? From here. Put it in. Let's accumulate depreciation. Then you have your book value. I think it's also important to mention, right? Do you see how over here in the makers, we calculated depreciation until year 4. However, in accumulated depreciation here, we only take it until year number 3. This is because, yes, even though we originally calculated it until year 4, we sold it off at the end of year 3. So the amount of depreciation that it has accumulated so far is only until year 3. So do keep that in mind, that we only take it until here. Okay, next step. Book value. Okay, disposal value. So depending on what the book value is, we need to find out if we have a gain or loss on disposal. If the disposal value is greater than the book value, then we have a gain. However, if the disposal value is lower than the book value, then we have a loss. If we have a gain on disposal, we have to pay tax. If we have a loss on disposal, we get tax savings. Therefore, this tax amount here is plus or minus, depending on what we got. Okay, change in NOWC, the same as in step 2, we do not have it in this case. So, terminal value of new asset is the disposal value, because we sell it off, right? The tax implication from it, and that's how we get our TVONA. And of course, we times it with the PVIF, and then we get the discounted TVONA. Now, to calculate net present value, we take the present value of cash inflows minus cash outflows. And it comes from here. This is your discounted cash inflows plus your discounted TVONA, and then you minus the initial outlay, and that's how you get your net present value. If possible, I would like you to try this out on your own, and in the next slide, we will check on our answers. Alright, how did you do? Did we get the same answer? Okay, I have 2 things I would like to share. The first is about the inverse relationship between profit and tax. See here in year 1, when EBT is positive, tax is negative. When EBT is negative, tax is positive. Likewise over here in the terminal value of new assets. Here we can see that the disposal value is greater than the book value, therefore we have a gain on disposal, and therefore we have to pay tax for it. The second thing I want to share is about operating expenses. So in this question's case, it is quite straightforward. It is a minus 84,000 per year, but sometimes you might find questions that are like, if the firm acquires this asset, the labor cost will decrease, or it will say it will save 10,000 in operating costs, or it will, yeah, basically things like that. So it's basically cost saving, right? In that case, you do not minus it out, but instead over here you will put plus 10,000, okay? Because you are saving costs, therefore that is more profit, therefore you have to pay tax, okay? So just try to think in this dimension, and hopefully it will help to avoid confusion when you eventually do this. As we calculated can also be used to find out the payback period, PP, or discounted payback period, DPP. These 2 are also capital budgeting methods, similar to the NPV, and they are ways that a company can use to find out if they should accept or reject an investment project. How do we calculate it? In payback period, the outflows 237 comes from here, this cash outflow over here. In DPP, it is the same thing because at year 0, we do not have time value of money. The inflows, 89,000 comes from here, 97 comes from here, and 104 is actually a combination of the operating inflows from year 3 plus the terminal value of the new assets. And then we get 104,000. In discounted payback period, we use discounted inflows or outflows, it depends. In DPP, we basically use discounted cash flows to take the time value of money into account. So year 1, 81,000 comes from here, 80,000 comes from here, 78,000 is 58 plus 20, so you get 78,000. Now let's look at the calculation method. So this table over here, it is up to you how you want to do it. I don't think the lecturer has a strict format that we have to follow, but this is what works for me. So I have a little balance column over here where I take the outflows, the balance, plus outflows minus inflows. That way I know exactly how much of the outflow left do I have to like reduce. Okay, so the balance here is 237 minus 89 is 147 minus 97 is 50. 50 minus 104. There's not enough balance, so we draw a line over here, and this is at the end of year 2. How we calculate PP is basically 2 whole years plus the remaining amount, 50,191.84 divided by 104, 551.84, and so you get 2.48 years before we can recoup our investment. Let's look at DPP. So 237, the same, minus 81, 155, minus 80, 75, and 75 is less than 78, so we draw a line over here, and this is at year 2 as well. So DPP is 2 whole years plus 75279.95 divided by 78, 549.80, and it will take 2.958 years. Notice how DPP is longer than PP. This is because the further away the money is, the less valuable it is. Now let's look at the interesting relationship between NPV and DPP. If you take all the outflows for DPP and then you compare it against the total inflows, you will get 3,200, which is interestingly the same as the net present value. So if you have any doubts and you want to check your answer, just juxtapose these two figures and see if you get the same. It should actually be the same. Alright, let's go on to the next slide. In this question, we're only required to compute until the initial outlay, so we don't do steps 3, 4, 5. Alpha Berhad is considering replacing the old machine with a new one. This is a replacement project. 2 months ago, the chief engineer completed a training workshop on the new machine's operation and efficiency. The cost for this workshop has already been paid. Therefore, this is a sunk cost, and there's nothing we can do about it, because no matter if we continue on with the old machine or we choose the new one, this 4,000 ringgit cost is not influenced, it's not changed, so it's not relevant to us. If the new machine is purchased, it will require 5,000 in installation. The old machine originally cost 90,000 5 years ago, depreciated by 15,000 per year, which we'll put here is 15,000 times 5 because it was bought 5 years ago. The new machine will cost 80,000 before installation. It will be depreciated by 5,000 per year, which I'm not sure where to put. The old machine can be sold today for 10,000. This is the disposal value. marginal tax rate is 28%. Okay, let's check answers. Did you get 73,600? Okay, moving on. Let's take a look at this question. Suchi Industries is considering a new assembly line costing 6 million. So 6 million goes here. The assembly line will be fully depreciated using straight line method over its 5-year depreciable life. So let's put in the figures. New machine depreciation will be 6 million divided by 5. Operating cost of the new machine is expected to be 1.1 million per year. And let's write it down. Operating expense is going to be 1.1 million. The existing assembly line has 5 years remaining before it will be fully depreciated and has a book value of 3 million. So we don't actually know how the original cost of the old machine. We don't know how much accumulated depreciation it has, but what we do know is that it currently has a book value of 3 million. If sold today, the company would receive 2.4 million. So this is the disposal value. Annual operating cost on the existing machine is 2.1 million. So let's write that down. Old machine, the depreciation, we're not sure yet. The operating expense is going to be 2.1 million. Sushi Industry is in a 46% marginal tax bracket, so it will be here. Tax here. It's going to be a 5-year cash flow thing. Another tax is over here. Required rate of return of 12%. So it will affect our PVIF percentage here. Calculate the net present value of replacing the existing machine. Okay. There's no other costs, no net of working capital. There's no mention of revenue, so just leave it empty. But we can tell that this question wants us to identify the change in operating expense and change in depreciation. Now this can be a little bit confusing, but as I told you previously, just think of it in terms of profit or loss. If it is a good thing, if costs will decrease, then you put a plus. If costs increase, then you have less profit. So it is a minus. Okay, so let's do the depreciation of the old machine. So we know that the book value of the old machine is currently 3 million. It has 5 years left. It doesn't say what depreciation method they use, but let's just assume that it also used straight line method. So depreciation for the old machine is going to be 3 million divided by 5. Okay, whatever number you get from here, just compare them. So we can already tell that the change in depreciation between the old and the new one. The old one is a lower amount, the new one is a higher amount. So you have to pay more depreciation, right? That means the lower profit, so it's going to be a negative. The change in operating expense in the old machine is 2.1, but in the new machine it reduced to 1.1. So it's a good thing. You profit from this, therefore it is a plus. Whatever you get here, the change, plug it in here. Now let's look at the table, see if there's anything we're missing. Terminal value, okay, we can calculate from here normally. There's no other cost, no net of working capital. You can take a terminal from here. Okay. Terminal value of the new assets. Terminal value of the new asset. They did not mention any disposal value, so it's probably 0. The total cost of the new asset comes from here, so this is gonna be I believe it was 6 million. Accumulated depreciation comes from here, and then you get your book value, and you can further calculate from here. Alright, in the next slide, let's compare answers. Okay, did we get the same answer? There's two things I want to point out from this question over here. If you look here, the accumulated depreciation of the new asset is 3 million, which we've taken from here. So 600,000 times 5 and we get 3 million. However, there is something that I've never been able to understand since the day I was taught this, because normally if you were to buy a new asset for 6 million and then you depreciate it to 0 at the end of its life cycle, it's supposed to have a accumulated depreciation of 6 million and a book value of 0, right? But for some reason, we were taught to take the accumulated change in depreciation. So I've checked my course notes and this is the way my lecturer teaches it, so we'll just follow it, just trust in the process. The second thing I want to talk about is, if you look over here on the right side, you can see that I've actually made an alternative table. It is for situations like this example, where if you have the same cash flow for every year, 816, 816, 816, 816, 816, you do not actually have to calculate the discounted cash inflows for each year, but instead you can just take the PVIFA table. So you only have to do it once. So the yearly figures for the change in revenue, change in operating expense, change in depreciation, and then you get 816,000 per year. And then from the PVIFA table at 12%, 5 years, you get 3.6048. You times it and you get 2,900,000. So you can see here that is actually the same figure, so both ways is accepted. Sometimes you might find slight differences, but that's only due to rounding and it is acceptable. When I first saw this question, I thought I was seeing hallucinations, because this is completely different from what we've learned so far from this topic. However, if you are in financial management, you most probably have taken the prerequisite subject called Principles of Finance, which actually teaches us about the cost of capital. So let's go through it together. Here you are required to calculate the after-tax weighted average cost of capital. So from here we know that this is WACC. If you still remember, in my illustration slide, I actually said that when we try to calculate NPV, we try to discount the present value. We try to discount back to the present value using either the WACC or discount rate or required rate of return. So this is actually how we arrive at that WACC. So the formula for WACC is actually the weightage of your common stock times your cost of common stock plus weightage of preferred shared, cost of preferred shared, plus weightage of your debts times your cost of debt after tax. And if we look up here, that it actually says the word beta. So if you see the word beta, most probably it is related to the capital asset pricing model, which is also known as the CAPM, where we calculate cost of equity KS. The formula for that is, under the CAPM model, it's KS equals to risk-free rate plus market risk minus risk-free rate times the beta. Okay, from here let's try tackling the questions one by one. As we can see over here, KS is actually comes from the cap M, so let's try calculating that first. Going through the question, Beta Sundar Bharat has 5 million shares, market value 3.81 per share, equity beta is 1.2, the yield on short-term government debt is 4.5, and the equity risk premium is 5% per year. And next we see that it starts talking about the debt finance, but debt finance is over here and it's not quite related to what we want to calculate for the cost of equity. So let's start with the CAPM model. KS equals to KRF plus market risk minus KRF beta. Okay, risk-free rate. The risk-free rate is not given to us. However, we do have this yield on short-term government debt. And let us assume that the government is very, very safe and therefore practically risk-free. So just take it because we don't see any other places we can take it for. Let's just follow the question. 4.5% plus, market risk. What is the market risk? It is not shown here as well. However, we do see equity risk premium. So to recap, previously in Principles of Finance, we know that the market risk is KM. However, occasionally you will see KM minus KRF, which is given as market risk premium. They have already net the amount for you, so let's assume that this is given to us and this figure is done. So it's 5% per year times the beta of 1.2. The cost of equity is 10.5%. Next, let's calculate the weightage. So they actually did not mention any preferred stock, so let's just ignore it. Let's try to calculate the weightage of the common share and the weightage of debt. Okay, weightage of stock is, let's see, we have 5 million shares times 3.81 and over the same thing again. This time we have to add what is the amount of debt we have. Over here it says book value of 2 million bonds. This is part of our debt finance. Par value, market value. Okay, let's just take the book value 2 million because we have no other figure to consider, plus 2 million. So this weightage of stock, weightage of equity is 0.905. Let's calculate the next one. Weightage of debt. It's the same thing except we flip it around to the debt portion. So 2 million divided by 5 million times 3.81 plus 2 million. So over here you will see it is 0.095. If you add up these two together, you will find 1. Okay, because we are talking about the proportion of these different securities. Okay, next step, we have to calculate the cost of debt after tax. So the cost of debt after tax is actually, from here you can see it is 7% and the tax rate is 25%. I'm not sure why the question talked to us about 1 year in arrears or capital allowances or straight line basis, because depreciation doesn't seem to be related to the calculation of WACC, so let's just ignore it. So KD is 7%, times 1 minus 25%. This is the after-tax rate. And we will get 5.25%. Alright, now we have all the required components. So WACC, which is the weighted average cost of capital, is WSKS plus WDKD 1 minus T. Let's plug in the figures. WS is 0.905 times KS is 10.5% plus 0.095 times what is the cost of debt we found earlier, 5.25%. And finally, we will get the amount 10%. Now, I need to inform you that even though I seem a little bit confused, which is true because I am confused, I'm practically just plugging all the figures I know into the formulas that I know. But I did steal this question from the course material, and the 10% answer does match with what the lecturer has given us. So do not be scared. You do not have to trust in my explanation, but you can feel safe that my answers are checked against whatever our lecturers gave me. This will be our final question for this topic. Question 3b. It is linked from the previous one. BSB is now considering a project where they will open a new facility in Malacca. The company's CFO has assembled the following information regarding the proposed project. It will cost $500,000 to construct the new facility. That's the asset cost. The cost of the facility will be depreciated on a straight line basis over 5 years. So let's take a note over it. Depreciation is 500,000 divided by 5. So yearly depreciation is 100,000. Yes, somehow I can calculate this without a calculator. Next, if the company opens a facility, it will need to increase its inventory by 100,000, and 70,000 of this inventory will be financed by accounts payable. So this is finally we have working capital. So inventory is a current asset, while an accounts payable is a current liability. Therefore, the change in working capital is actually 100,000 minus 70. Remember, asset is a plus, liability is a minus. So our change in working capital is 30,000. Next, the CFO has estimated that the project will generate the following amount of revenue over the next 3 years. 3? I wonder if our cash flow is only until 3. So year 1 revenue, 1 million, 1.2, 1.5, put it here. Operating costs, excluding depreciation, equal to 70% of the revenue. Okay, let's keep going. Operating costs for year 1, year 2, year 3 is going to be 1 million, 1.2, 1.5 million times 70% times 70%, okay, equals to whatever you get here, you plug it in here. Okay, depreciation 100K, we put it in here as well. Change in working capital 30,000, we put it here, and also here. Let's put it here for now, see what the question says, okay? Because look at my notes, it says terminal value of new asset. You add back the change in working capital if it is fully recouped. Let's come back to the question. The company plans to abandon the facility after 3 years. Okay, so it is confirmed. We stop at year 3 and our N is going to be 3, 3. So our cash flows will be, so everything ends after 3 years. 3 years. At terminal year, the project's estimated salvage value will be 200,000. So salvage value 200,000, put it here. At the same time, the company will also recover the net operating working capital investment. Yes, so it is true then. The net working capital we outlaid in the beginning, we will get it back at the end of the year. So let me explain what I think about this net working capital, okay? It is essentially, let's say right now, I have to expand working capital of 10,000. In this case, 30,000, okay? I have to expand working capital of 30,000 right now. So it is worth 30,000 at its present value. However, this project is lasting for 3 years. After 3 years, I do get back that 30,000. However, that 30,000 in 3 years is worth a little bit less now. So maybe its value when you discount it back is maybe like 25,000. Yeah, so that's why we have to take working capital into account. Next, the company's tax rate is 27%. Okay, tax implication is over here and also here. The project cost of capital is as per calculated in 3A above. So from this, we know that we calculated 10% up there. So the PVIF will be using 10% because that is our cost of capital. So we cannot go any less than that. Okay. So it's pretty sure that we don't have an old asset over here. We have, let's see, with asset cost, no other cost. Okay. We can get the cash outflows over here. This is pretty straightforward. And terminal value. Terminal value of the new asset. That means because from here the total cost is 500,000. The accumulated depreciation is 300,000 because the lifespan was supposed to be for 5 years, but we've only got until the end of 3 years, so it's gonna be 200,000, and it's disposed at 200,000. That's interesting. So we do not have any gain or loss, therefore no tax. So we only have the working capital that we recouped over here. That is very cool. Okay, and then we times by the PVIF, and then we get the terminal value. And yeah, let's see if we have the same answers in the next slide. Did you get the net present value 373015.47? Alright, thank you very much for watching my video. Bye bye.